I think after all that, I'm starting after all. In my comments or my views, I would like to sort of start with a question, and that is, what is the passage of time or activity between buying and selling and crying? It's one click. This is a trading market these days. This is not an investing market. Okay, what is oversold on Monday seems to be overbought by Tuesday or Wednesday. There are a lot of things that accrue and are part of this sort of sector. However, most of the time, companies are a victim, in many ways, of their own circumstances. I mean, not always is the market the victim, or the market is the cause of some of these sort of causations. It's at this point in time, it's the end of the year. And what you are seeing is essentially traders want to exact any sort of profit that they can take, even if there's good news. Look at some of the results from ASH. Look at some of the results of the hematology conference. There's been some good news. There's been some partial news. But traders and programs sell into that news, and again, volume has been unspectacular. The current market situation for our universe was and is created by a storm of mutually reinforcing trends. A lot of it is concerning the lack of solid clinical data, the lack of capital market access, or just, in some cases, toxic financings. But again, there's, as I've called it, there's a lack of economic efficiencies and accountability to shareholders. And I call this a sort of, it's our universe. So I own this. I've been part of this for 20 years, going back to the investment days when I sort of had a role similar to Jeffrey and Ren and Stephen. But again, there are issues that concern me from this side, and a lot of it reduces or comes down to governance, comes down to transparency. I mean, I look at the numbers, and Jeffrey says it's your headlines that you write every day sort of articulate your views. And so I said, God, I didn't think so. So this morning I sort of looked, and what did I say on Monday? The sector is crowded with unsustainable pricing. On Tuesday, why close the barn door when the horse is already left on its own? It's sort of Wednesday, we're mired in disappointment. Sort of Tuesday was a rebound in volatility is not a huge surprise. Well, on Monday, another volatile day as the sector gets its clock cleaned. So I don't like to be negative. I love this universe, but the reality is there are facts and evidence, and that's sort of what I put out there on that side of it. I won't go into the specifics because we have others, but sort of sets the tone at the moment. We're sort of in a perfect storm. And I'll leave it at that till my colleagues have a few, hopefully, positive words to say. Thank you.
Do we have to get up, or we can stay here? I'm gonna sit down and just talk. So I'm Ren Benjamin, a senior biotech analyst at Raymond James. I've been covering biotech now for 13 years, and regenerative medicine has always been a very important part of our coverage. You know, both scientifically, have always felt very positively on obviously the science and the future potential, obviously, of regenerative medicine to really meaningfully impact and change patients' lives. That being said, you know, most of us who have to deal with clients, you know, and facing them, have to deal with the realities, as Henry brought up, about trading, about the fact that a lot of them are measured on, you know, monthly, if not quarterly types of bases, and have to lock in gains because they're being paid to actively manage someone else's money. So as much as we do occasionally run into the regen med or the gene therapy believer, you know, a lot of times they can't either invest, or once they invest, they get out, you know, before a binary event. They're just not there, you know, as the long-term investor, the Warren Buffett sort of investor that we all hope for. Okay, and frankly, from a company perspective, I don't think you should care. What you need is the capital to move your product forward, and the investor, you know, who's managing their funds can get in, get out any which way they want, as long as you have the capital to move things forward. That's what, as a management team, should be the most important thing on your mind. Just from a macro level, you guys all see that biotech is taking it on the chin. We've had 4 years of an outstanding run, and I think this year we've given back all of our gains, and this may in fact mark the turn of the biotech sector. The good thing for a lot of public companies is that a lot of them have raised significant capital. So there's a lot are sitting on 2 years, you know, or more of cash to help them weather some sort of a storm. That's not the case in the regen med space as much, but definitely broadly in biotech. And no matter what kind of market it is, even if biotech is turning around and it's an election year and pricing is going to be, you know, an issue that probably creates a significant amount of volatility, the two things that drive biotech sort of, in my mind, independent of what sort of year you're having is obviously the data. You know, positive clinical trials buck any sort of market trend that you see. And then, of course, M&A activity. You guys all know that last quarter, I think Gilead mentioned that they have $25 billion with a B in cash, and they're looking for acquisitions. Amgen is going on a $10 billion shopping spree, you know, and this is all good news for our sector. And when I talk with clients, right, who granted are worrying about the trading that's happening right now, the underlying fundamentals, in my view, you know, positive data, M&A, the fact that these pharma companies, you know, we've just had the biggest mega merger now with Pfizer and Allergan. The one thing that a lot of these mega mergers are not solving is the pipeline problems that they have, right? So they're joining revenues together, they're saving on expenses, but a lot of these are going through generics. You know, a lot of the products are going to go generic anyway, and their pipelines are still bare. And the only way for them to solve the pipeline issue, because they're jettisoning R&D individuals at the same time to keep expenses down, is frankly to buy products from biotech. And so I think the future for biotech is great. I think the challenge for regenerative medicine is immense, just given the stage at which they're in. But the possibilities are immeasurable, okay? There's a big need out there to fill pipelines, and I think Regen Med and biotech could definitely do this. The challenge for you guys is, you know, obviously raising capital when you can so that you're funded to get through to the end of you know, a particular clinical trial. Probably most importantly for me as an analyst when I'm looking at companies like a lot of you is you know, hoping beyond hope that you guys have designed the right trial. And a lot of times, unfortunately, to be honest, companies take shortcuts, and it's a reflection, unfortunately, of how much money you're able to raise. But sometimes you have to make the hard decisions, take some additional dilution, whatever's the case, but design the right trial. Because I'm a firm believer that, you know, 7, 8 times out of 10, it's the company that fails the drug and not the other way around. It's the other way. But I know we'll be discussing a lot more issues, but I'll stop there and give it to Steve.
Thanks, Ren. I'm the guy that brought the slide, so I actually have to go up here. Before I start, I always like to know the audience. How many folks here run a biotech company or are in charge of biotech projects? And how many are scientists? Or scientists not doing that? Okay. I'm not going to disagree with Ren or with Henry, but I am going to start to go out and explain some of the stuff that I've seen. Since we're in Atlanta, I thought I'd just cheer up the place, warm it up a little bit. You see a picture of Sherman from a lithograph going back and having a little barbecue here. I think the people still remember him a bit. And frankly, in going back to Henry, I think the first time I heard stem cells was called primordial stem cells, and it was a quarter century ago. And frankly, it was one of these situations where, what the heck is this? And they were still thinking about anti-TNF and anti-angiogenesis, and it was kind of unusual. And I'm going to tell you that money is critical. Ren, did a great job in explaining it, and frankly, it's one of those things where if you have to pick, what are the three most important things about regenerative medicine, I would say money, and the other two are not important, okay? But money will get you access to development. The problem is, you're not Warren Buffett. You can't do it just by saying, I'm doing it. Visibility is also critical. And I'm going to go over some examples very concisely, hopefully. I don't know if you can see this. That's a Geron IPO document. 20 years ago. 20 years ago in New York City, JP Morgan, Montgomery, and Solomon. Of course, the two banks on the right no longer exist. I fought to get in as a co-manager on this deal. Really fought. It cost me money. The deal went south right from the get-go. How could a deal like this go south? The CEO, 2 weeks before, had gone to Davos and was seated at a table. On his left was Bill Gates. On his right was Warren Buffett. And I was like, they were asking him like he was the rock star, what do you think? And of course his answers were, well, the reason I was interested in was in telomerase, but they had telomerase, telomeres, and primordial stem cells, and he started to talk about it, and obviously both of these guys had more money than anything else, and they wanted to know what could we do in terms of getting that point across. What could we do? And frankly, I knew there was a problem, because at a meeting the very next week at the Four Seasons, where they had a due diligence sit down, and they were going out there, and the road show was taking place, they couldn't find enough people to attend. So I'm listening to this guy talk about the future of science, and they've got summer interns from JP Morgan in the room to fill it up so it doesn't look bad. So feel like you're the guys that are filling up the room so that you understand, and they just skip the people not to make it look bad. Okay, Geron goes public. People start to talk. Controversy, visibility. This is from the New York Times Magazine. How many times do they get it right? I'm not picking on them. You could have the Washington Post, the Wall Street Journal. You could have any of them. They were all running the same stories. Problems happen, though. And this is the first time I've ever seen this problem ever happen. When a government goes out there and starts to constrain things, weird stuff happens. Not just in science, but in the capital markets. And as a result, you know that Geron was constrained in terms of what they could do into the future. Now, I'm not picking on embryonic stem cells, because I follow adipose, I follow mesenchymal companies as well, but STEM went from being this term that was regenerative medicine, went from being this term that was the be-all and end-all to a 4-letter word, literally. And at that point now, you had a situation. What is the visibility? And I'll ask you again, what visibility do you want? What are you going out there and saying? At the end of any presentation, what does someone remember from what you just said? Because if you don't have something solid where they can basically say, wow, they can do A or B. If you just go out there and wow them with the science, well, they're just going to remember this was really important stuff, but that's where it stops. Now, what happened? Back 5 years ago, we had the moratoriums lifted on stem cells. So I'm not hired for my personality. I pretty much am outspoken. Nature reaches out to me and says, would you like to go out there and explain what needs to be done? So I said, okay, and frankly, it was like a 28-hour project. I had our folks out there, and we basically looked at what the stem cell ruling would do, and then we, as the bankers in there said that U.S. firms, U.S. shops would all be left behind. I was wrong. The entire world was left behind. The amount of work that was done, the amount of effort, everything along the lines was pretty much frozen. And as a result, you started to see behavior that was different. You started to see money follow things that were more predictable. There's nobody in this room today, and certainly I've never seen it, that can tell me of a project that's taken place in any scientific endeavor where at the beginning they had this idea and at the end they exactly matched that idea. It doesn't work like that, but Wall Street demands that. And that's where the crux of the problem is. You've got to go out there and you've got to tell them what you are. And have enough in your back pocket to say, well, opportunistically, this is also what we can do. And when that piece of serendipity hits, that's when you go out there. You know, everyone here is going to tell you more money's been raised, more money is in the wings. But frankly, it's in the wings with people that frankly need the needle to move this way on $20 billion. And that's almost impossible. I'm sure everyone in this room can do more with $10 million than they can do with $10 billion. It's just the facts of life. You don't have to go out there and account for paper clips and such. You don't have to go out there and have global meetings. You can actually do things. It's important that you get that message out. Because if you don't get that message out, well, the myopic analysts, bankers that are out there know that they've got to make sure that they can tell their clients what to do. And right now, if we went back to that original slide about when Geron went public, and if you had purchased all of the stem cell regenerative medicine stories at that time, you'd have enough tax loss carry forwards to carry you through the next millennium. Now the question becomes, what do you do next? And here's why it becomes interesting. Because usually when something is so bad, there's probably something just around the corner. I'm not going to tell you what it is. Because frankly, I understand some of the concepts where you're dealing with the basic building blocks of life. And when you're dealing with something that powerful, you're going to see something, all right, but it's probably going to be a lot different than you expect. And the idea is to make sure that you can telegraph that. How do you telegraph it? Well, in the old days when I started, there used to be probably 20, 25 stone-cold reporters that could tell a story, that could understand it. We're probably down to 5. So the idea is that you should be able to understand and explain anything that you see into the future, anything that you do into the future, to the third-party media. Because it means a whole lot more if someone's picking up the paper and they say that New York Times piece or whatever. I'm not telling you that this is the right way to look at the system, but I am telling you that's the way the system works. The other part of it is this. It's one of these situations where you're going to go out there and you're going to say, I'm breaking my back for nothing. And then all of a sudden, something will come up. You'll have some test that'll come back. You'll have some call that'll come back from 14 different time zones away, and then you're off to the races. It's that proverbial S-curve. The harder you work now, later on at that point, you or someone you know that knows someone else is going to have success. And then there isn't enough money and time out there to get the money to you. They'll be trying to say, I want something just like that. The question is, do you have enough money to make it, as Ren put it out there, and can you go out there and go out and really overcome the slings and arrows of this outrageous fortune? I'm not going to tell you how to do that because, I'm the Wall Streeter that basically says, okay, if I have to bet, typically I'll bet against something. But this is too important to bet against something. I'll leave you with this last slide. That's Atlanta as it looks today. So before you can go out there and build, typically you need something to build on. And the type of destruction we saw in Atlanta made a modern city.
Thanks, Steve. So I think we really wanted to open it up for questions, and hopefully we have some. And I wanted to get started with the first one as we talk about valuations and companies and capital and objectivity. So we wanted to kind of maybe go around and talk about therapeutic areas, where we're seeing glimmer, where we're not seeing glimmer, and some other thoughts on that front. by the way, there's still Geron folks around 25 years later, and they're still well paid. Just so you know. So,
I can remember just from the past that I was one of the original investors from something called Hembrecht and Quist Capital in Geron, where I invested in Michael West and Tom Okama, okay, and a couple of individuals. What was it? Ron Eastman was there. So it was interesting when it did go public. Then you look at Mike West is running Biotime, Tom is somewhere running something. But again, there's a lot of these people are still around. You go back through a lot of these companies and what transpired. There's an institutional history here where things have worked, things have not worked, things have been reworked. So it's a question of, I wouldn't give up now. It's time, if you really believe in what you do, to focus on that belief. But the whole issue of focusing on that belief is selling it to someone else. Selling it to those people who can provide for you the perception. But it's up to you to define the clarity of what you need them to know. And at that point, I believe you can move your stock in many cases if you're a public company, or you can, sort of manage your image on that basis. I'll throw that one back to Ren on that side.
So tell me, the question is for valuations?
Let's go to valuation.
So if when I look at the space, the regen med space, or I meet sometimes with companies, I don't know if there's any mesoblast people here, but everyone likes to ask me, I don't really understand the valuation of mesoblast and why aren't we valued as much. And the fact of the matter is that the market's a schizophrenic place, okay? And just because one day you're doing extremely well, or for a year your valuation's very high, it does not mean that the next year things won't change, right? And so when we look at valuations, or I'm trying to figure out what a company's appropriately worth, it's completely made up of the stage that they're in. Are they phase 1, phase 2, phase 3, right? And more value going to the phase 3 companies because you're closer to launch. The other thing that impacts our value is obviously the markets that they're addressing. Is it a fractured sort of market? I'm not a huge fan of wound care. It could be that I just don't understand it, or that I followed it long enough that I think it's a very fractured market and that no one seems to be able to make much headway there. That'll affect my thought process and how I would value a company, because everyone who comes to see us, everyone has $1 billion product. It's guaranteed, right? Otherwise, you're not starting a company. And then it's the analyst's job, right, to kind of sit back and break that down. Well, okay, it's $1 billion, but you're in phase 1. So the chance of this working is maybe 30%, right? So then suddenly it's a $300 million product. And then the $300 million product only gets to the market 5-6 years from now. Well, okay, that's when it starts, and then probably becomes peak at 300 another 5 years, from that point, right? So now you've built out your model, and you have to discount that back. So lo and behold, by the time your $1 billion product makes it to market, gets to the sales that you think that it will be after you've taken your cuts, it's probably worth about $50 million right now, right? And that's how we come up with that value, right? Or $100 million, whatever's the number, whatever your model pumps out. And then, of course, you add the esoterics like, management experience, and have they done it before, and if not, how credible they are. Lee.
How much do you value partnerships? To me, one of my mentors in the field is what Ed Laffer's done with Thalmann. He's always been ahead of his financing needs, I think, in many respects. He's got lots of nice partnerships in place. How much do you value that when you're looking at a company, just on the partnership front?
So they asked me to repeat some questions. So the question is, the value of partnerships when we are valuing, biotechnology companies. And I guess the way I would answer it, and I'd ask these guys to comment, it depends on the partner, okay? And it depends on how much they're ponying up, right? So a lot of times, I look at, a lot of, in the regen med space, right, there's a lot of partnerships that are happening, especially from Japanese companies, okay? I probably, view that a little bit lower on the totem pole than, let's say, a J&J or a Pfizer comes in. But even if Pfizer comes in, right, I don't suddenly, check the box that says, well, this will definitely work, because why wouldn't Pfizer come in? Because I got to tell you that, those BD guys, sometimes I don't know what they're looking at, right? Other times, $5 million is a drop in the bucket for them, and they just want, a piece of the pie. Other times, they just want some IP, and they could care less about, that particular product. So it's a long-winded way of saying it's great to have partners. That's an added validation. You'd like to think that they signed a CDA, they looked under the table here and really found out kind of everything they could and then invested. The more money they invest, the better we feel when we're looking at companies, right? If it's something small where we're not too thrilled about it, back-end loaded biobuck deals, not a huge fan of. And then the caliber of the partner is very, very important. If the partner has made other deals in the space that have actually been successful, that's great. I mean, I'll give you an example in oncology, and I hope there's no Merck KGaA people here, but like Merck KGaA, in my view, right, and it could just be because the last 4 deals they've done have all bonked, right, but maybe they do have a good BD team before that, but I think they stink it. They, if that's your partner, it's a 0 on my, on my list. So, sorry, long-winded way of saying, it depends.
I think it also depends on milestones. I'll insert Steve for a minute. On the milestones. And if you can get a credible upfront payment, you get credible milestone payments. But if you look at the most recent deals with a number of RegMed stem cell oriented companies, they're option deals. They're there if and when maybe we might. And they give you a few bucks to buy you off and keep you quiet. And then it all depends, do they want to execute that option? Stephen?
Okay. Every year we get 20 interns from across the country, usually about 10 in the summer, and I all have them start racking their brains on discounting cash flow models, going out there and doing all the statistical references, and I say, you've got to do it. Why do you have to do it? Because when you're figuring out your taxes, you have to figure out what you're going to pay. But a lot of people, and I'm not ascribing to this, if anyone's listening from the NSA, they figure out what they're going to pay and then they back into it. The realities are that there are intangibles that sometimes, when you were asking about who the partners are, sometimes they're going to do a deal not because of the company, not because of the technology, but because of the person that happens to be licensing it at one end, and the guy that's on the other end happens to be a good buddy of his. And that has its pluses and its minuses, but candidly, it's one of those things you really have to look for. Because when someone just does it on that kind of a handshake, typically there's less technology involved than I'd like to see. Now, in terms of what I don't like to see is a situation, and I'll use a good example. I did the initial public offerings for Celgene when I was at Dean Witter, and the company languished for a long, long time. And they had deals with a few partners, but it was like basically going out there and selling their blood. At the end of every quarter, they had to look around, where were they going to get their next fix? And it was really a difficult situation. It was touch and go. And Frank Carey, formerly of IBM, was a director. And I remember when the CEO, when he was just a poor millionaire, would say that was the strongest asset he had. Because when he'd go into a meeting, he'd say to them, would Frank Carey be a director on Celgene if it wasn't a real company? At the end of the day, at that time, it seems like a naive statement today, but it was pretty much true. What else did you have to go on? And whoever the heck heard of anti-angiogenesis? So the idea behind it is, You have to know those numbers backwards and forwards because obviously you've got to defend them. You've got to be able to say, here's what we're looking at. But at the end of the day, if you really think that you can forecast something that's going to happen, forget about 10 years from now, 5 years from now. That's a tough road to hoe, especially when you have regulatory agencies, especially when you have issues of manufacturing, especially when you have potential competitors. These are all items that you basically want to think about. And the one thing, though, that John did mention when we were taking his company around, and they actually got into the stem cell space, but frankly, they've been opportunistic with other opportunities. He basically said you always have to have a plan B. And your plan A always has to be ready to morph into something else based on what you're looking at. The idea is if you're lucky enough to get a partnership with a big company, you better be prepared to have that thing morph into something else. Because if you blow up, well, obviously your friend blows up, but it makes it 10 times more difficult for him to do anything else, and forget about what happens in the future. Now, Ren was kind enough to talk about Merck AG. I really love seeing when they enter into partnerships in the old days, because their idea of going out there and telling visibility was allowing you to basically put their name on the letterhead, using their letterhead for the press release, and then you didn't hear from them for 6 years. That's not the kind of partnership you want, even if it comes with money, because you're just not going to get anything else out of it, period. Now, not to just throw stones, and I'll end on this, Lilly was really great. I remember one deal we were advising on where they stopped doing something in a diabetes area, said you can keep the money, and then a year after, they went back to the same company and said, we really want to revisit this deal. And I was like, this is Lilly? Come on. Or Pfizer, obviously the flavor of the week. I can remember once, right after they acquired Wyeth, basically going out there and saying they were shutting down a dozen programs because they wouldn't move the needle enough to make any difference with their new entity. These are realities that you have to think about, and they're much more difficult to put on a spreadsheet and try and quantify.
Yeah. We'd love to take some questions. Yes?
I'm just interested in a more technical question. How would you calculate cost of equity? There's competing models. Just curious.
Are you talking about the question was, how would you calculate cost of equity? Are you talking about a Harvard Business School model, or?
But I'm not wondering, there's CAPM, there's others. Just curious.
Okay. Well, this is recorded.
Oh.
But I'll tell you what I tell the interns. Okay? Three accountants are basically waiting an interview for a job. First accountant goes in, what's 2 and 2? 4. Thank you very much. Next. What's 2 and 2? 4. But in some cases, they tried and see if they could make it into anything else. No, it didn't work. It's 4. Thank you very much. Last guy comes in. What's 2 and 2? What would you like it to be? Okay? It depends on the bona fides that you have in terms of who are you. If if you're one of those people that can go by one name in the biotech field, you know who I'm talking about. Your cost of capital is very, very low. And if you're going out there and you're a researcher at a credible institution and you're living on peanut butter and banana sandwiches, well, you're talking about a very, very high cost of capital. Those are the realities. Although, I'll open it up. Anybody else want to go out there and affix what the current cost of capital is? Because right about now, there is one wild card in capital for public companies, but I'll come back to that a little later.
I was playing with comparables. I was always trying to define the universe that surrounded that particular technology. Who is in your space? Who is a cousin? Who is a brother? Who might be just in the periphery that might render a value to you on that basis? And that's how I used to but I always used a beginning, I'd set up a direct comparables, Jeffrey's gone through this, direct comparables, sort of related comparables. I would look at a sum of the parts, and then I would blend some things together to try to come up with a sort of valuation process?
You know, I think relating to what Reni spoke about earlier as far as valuations and what we look at, in biotech, typically you'll see a model of projected revenues, assuming a product gets approved and gets to market and becomes a billion-dollar product, which is then discounted back. Others in different areas, such as medtech, you know, I may look at something, a revenue multiple or an EV over revenue multiple, and I may grab that number out a year or 2 years. I recently looked at something out, a 2020 number discounted back 4 years at a 14% discount rate. So PEs is probably, maybe I have to explain what that is for this crowd. So does anyone, there's no money earners out there? Okay, so that's not relevant.
Doesn't it say how many, in a way, I can make numbers live probably than anyone, okay, better than anyone. But the whole point comes down, when are those revenues expected? If you're gonna put them into a model now, when are they expected? 15 or 16 years? And how basically, if you look at the price targets these days of some of these stocks, okay, on the basis of those sort of projected revenues, there's some question.
Well, actually, it's a good question for Stephen Reni. If you could comment a little bit on price targets, particularly in the public domain, an analyst price target, and what it may or may not mean, and how it relates to the company.
So,
We won't mention any other names that we know.
right. You know, I guess when you know, we usually, the price target is a function of our models, right? The way I'm typically calculating the value of the company, as I mentioned, is, you know, figuring out exactly when the product is coming out on the market, when is peak sales with all the appropriate discounts, and then discounting it back, usually at around 30%, okay? That goes down to 20% once you get a positive phase 3, and 10% at best once you get a product out on the market, okay? You know, obviously you can use the formulas for this, but there's just an inherent risk, you know, that typically keeps my discount rates higher than, let's say, the regular, you know, let's say your Coke or Pepsi. Then I always do slap on a multiple, right? Because no one is paying, you know, 1 times, you know, what Apple will make next year, right? They're paying 5 times or 10 times, whatever is the case. And in biotech, the average multiple, like when you add up the profitable companies and you kind of take a look at what investors are willing to pay, it's 6 times to 10 times revenues. So if you're going to make $1 billion next year, you're going to be worth roughly about $10 billion in market cap, okay? And in terms of PE, it's usually, right now, it's closer to like 45 times, okay? But in our models, we use anywhere from 26x to 30x, okay? And we get the two numbers and we take the average of the two. Now, if the stock price, you have to remember, right, we're on Wall Street, we're at sell-side firms, we're not only providing, you know, the research, but, you know, we're also, you know, typically friends with the companies, you know, and the whole bit. So if you plug in all your numbers and your price target comes out at $30, okay, and the stock is at $28, right, you have 2 choices. You go out with a neutral, okay, or you rejigger your numbers, right? You go back and you say, well, okay, where is it in my model that maybe I'm being too hard on them? Or what if it works out a little bit better than what I thought, right? So a lot of times in our models, we take, you know, just drastic cuts. You know, we say, well, they think that they can make $1 billion, you know, in revenues, but I think they have the wrong patient population. I think it's only going to be half that or a quarter of that, right? So we might say, so my model might have 250 million in revenues. Well, if I bump that to 300, which 50 million here or there between friends and 10 years out means absolutely nothing, it has a change in your value, and it allows you to potentially go out with an outperform rating or a buy rating, you know, over something as small as $50 million. So the price targets, I think, probably part of the question was you have to take it with a little bit of grain of salt in that they can be fudged here and there. On the other hand, the assumptions behind it, I think, are very, very important to pay attention to, right? If I think it's a $250 million product and the company is saying $1 billion, well, then I would want to pay attention to why does Ren think it's $250 million. Ren can throw on a 30x PE multiple, right? If that's what he wants to do, just to get the price target a little bit higher. That can be fudged any which way. But paying attention to the patient population, the numbers, and most importantly nowadays, the price of the product. Those are the things I think you can glean more importantly from price targets and valuations.
Ren brought up a couple good points, but I'd also like to tack on a few others. PE, again, not too many people here familiar with that concept. At my firm, we don't use quarterly PEs. They're useless. Frankly, if you get them right, you're probably in too close with management. On an annual PE basis, that's a different story. You have to do that, and you have to say, what do you think? Because that is reflective of how much cash they've got, how much they're going to burn through, and when they need to come back to the capital markets. But it's a game in terms of the way the monitors set it up, because if a company that's losing money, has always lost money, will lose money for the next 10 years, misses their earnings for that quarter, it sets up these red flags at these reporters, and they go out there and they say, the company missed the earning consensus, and all of a sudden now you've got a situation where there was no story and you're creating one. So these are real issues, and the idea is that even to this day, Wall Street doesn't really explain it well enough in terms of these companies and understanding how earnings work. But there's another area too. Let's say you go out there and you put a price target on a company. There's two prices. There's the individual share price, and then there's a market cap price. So let's say, not to pick on you, but you're running a $150 million market cap company, and you are running a $750 million market cap company. Oh, no, sorry, $400 million market cap company. Let's say you go up by 100 and you go up by 100, based on what the targets are. Your 100, even though it's percentage-wise much, much more, is less valuable than his 100. Why? Because there's portfolio managers out there that cannot buy a company unless it has a certain market cap. Because even if they win, they lose. They have to explain, why are you going and being so risky? If you're at $500 million, you've got more legitimacy. If you're at $250 million, sorry, call us back and we'll buy as much as we can when you hit 500. And not to make you think that this is absurd, but I've actually given a haircut to the modeling that I'm talking about, because we're in the regenerative medicine space. And there aren't any companies that are even close to these numbers for all intents and purposes. But if I was talking about a stone cold CAR-T type of company, well, guess what? Tack on another 500 million, because now the numbers go to the billions. And those are real numbers that we have to consider, because if you write a research report and no one reads it, what difference is it going to make? And that's a critical issue.
I think I wanted to take up, any questions before I take up a, yes, sir.
There have been a couple of large private transactions. Denali's one, Theranos is another in a lot of side of regenerative medicine, but especially Theranos. I was wondering, what is the basis of those valuations? Is there a technology they have in place, they developed, or they've been licensed products?
I'll just repeat the question. The question was, what about some of the unicorns out there and what types of technologies they might have? Steve?
I just wrote a piece in Forbes on Elizabeth Holmes and Theranos, because I was saying, okay, according to the last transactions that are private, now just private, so you have to give the benefit of the doubt, they're at 10 billion. So I basically said, okay, you're at 10 billion, what are you going to do to basically accept and integrate into the market? And candidly, I was caught off guard when she said they're going to continue to stay private. Now, it was sort of like, okay, there's a failure to communicate here, straight out of Cool Hand Luke. It's like we're speaking in two different languages. Because at this point now, you've got a serious credibility issue, because you're going to have to go out there and explain what you're doing to the masses, and that doesn't lend itself too well as a private company. But the idea is, again, on the private transactions, they're more difficult to value, and sometimes it's a situation where a lot of documents just simply aren't there. And a lot of times there's scarcity value for things. What was the first CAR-T company going to trade at? Not very much. The fourth or the fifth, well, that's another story because everybody wanted that. So, you know, it depends on what part of the cycle you're talking about. It depends on the visibility you're talking about. It depends on a diagnostic company that in theory is going to be applied to everybody in the universe, even though they're not thinking it through in terms of, you know, the revenues and everything else. You know, that's a pretty big number. So, and then if you limit the number of investors, it now becomes much, much easier to go out there and make these types of decisions. Did I answer your question?
The secrecy factor hurt here by keeping so many things quiet and letting those few investors roll up the valuation sort of cost her in those sort of markets. Because just as the public markets have a problem with valuing that, so don't the private markets. I mean, I'll go back to a story, I think a couple of people who know me. At one point on the venture side where I was for 18 years, okay, I was called on the carpet 3 times. 3 times. My job, they told me just before I went in the conference room, Bill Hembrick is in the door. I'm like, okay. And I had to explain myself why I had put in a total of $25 million into this guy named John Martin, who had a company called Gilead. And look at Gilead now. Yet that same sort of question of perception exists in the venture side as well as exists on this side. And I tell you, it was pretty shaky there. They accepted my explanation because I had really not done a quantitative review. What I did have one. I did a sort of qualitative review of what was transpiring and what he had. But it did convince them at the time. But look at it now. So again, it's a crapshoot sometimes. Look at some people in the audience. There's some tremendous things going on in this one company. They're focused on the trachea, the bronchi, the esophageal. Nobody else is playing in that there. And they've got credible results. Okay? Yet as time goes on, it becomes more like a snowball going downhill. But you want to be careful with how fast you want that snowball to go downhill in many cases.
Jeff, why don't you ask, because you haven't said that much.
No, I actually want to take up a couple topics. By the way, everyone knows that all the companies in this space are down 20% this year, right? And 20% over the past 3 years. And the average company is burning through $40 million a year. So that's $1.6 trillion in 43 companies, which at about $250 a year cost is about 6,500 researchers. And so 1.6 trillion, which means that we're going to see, according to Reni's formula, at 6 to 10 times. So we're going to see 18 trillion in revenue in a few years, right? No.
So, I mean, I'll go back to that private, comment as well. You do have the fact that with these private companies, right, you have a relatively consolidated group of, what could be believers, and they're usually talking to each other. And when they're talking to each other and they're all believing the same thing, the valuations can get vastly skewed, right? The public markets, it's a little bit different because there's now millions of participants, right, that are coming in, and there's a lot of different factors. There are people who are able to short the stock. There are people who need to sell the stock for no other reason than they just need, money. It's in private land, they've gotten to $10 billion because every time they've had to pony up more money, they're not going to go on a down round themselves. If it's the same people coming in, they're going to say, well, okay, well, this time she's made progress. I want to make it higher so that it looks good for me too, right? In terms of my internal rate of return. When I go to other investors, I'm going to talk about how I got into Theranos, right, at whatever valuation in the beginning, and look at it now. Everyone's saying it's a $10 billion company. So it's a little bit of a wild, wild west, and you know, I wouldn't, as a public company, I wouldn't necessarily just rush to be private again, because the exact opposite can happen. We meet with private companies all the time who say, well, you know, the public markets are really valuing similar companies much better than our venture guys who are really trying to, you know, kind of hammer us down. I prefer the public markets from a perspective of just, you know, transparency, and letting kind of all the factors, all the players kind of have their war, and you know, showing this, let the stock price kind of give us a good sense as to how this is, you know, how things are working out.
But yet, currently in the regenerative space, most of the companies are still private and very small and very early.
Right, and look, and there are several public companies that are here that, you know, like Jeff just said, the stock market has been not so nice to the regenerative medicine space, right? But I'll make the argument that the regenerative medicine companies have not been, you know, that nice to investors, okay? Because things have failed, right? Things have not worked out the way that you had originally planned, which, you know, granted, as investors, we understand, right? We get, but if after investing for so many years, let's say you bought into all this, none of it panned out, you are just going to be that much more wary the next time around. And so we need, you know, I'm a big believer we need credible companies with credible messages going out, and then frankly we need a little bit of luck on our side. We need some success, right? Everyone loves CAR T-cell companies right now, and everyone's a huge fan of immunotherapy. Well, immunotherapy, it was a 4-letter word, right, all of like 5 years ago, okay? Every cancer vaccine had failed. It's kind of like going back 20 years for monoclonal antibodies. And then the first one worked, right? And then multiple things kind of came through. And so, you know, I'm a big believer that Regen Med has to go through that cycle. I just don't know when, you know, kind of that first success is going to come through, to kind of be able to point out to investors, hey, look, we've hit the hump. We're, you know, now we've got our first success. It's gonna be followed by a lot more.
But you still have issues. I mean, look at sort of the hot, everybody's love of the week or the month was Bluebird Bio, BLUE. I mean, trading at 58.68 about probably an hour ago. Okay, 470 million in cash. Okay, the trading range for the year is 48.85 to 197.35. It's traded as high as, and they had a $225 price target. But look at it now. Look at a couple of the stem cell companies under $1. I could pick off 4 of my sort of current 43 that I look at. Look at there has been some things on the M&A side. You look at Cellular Dynamics was bought by Fuji. You look at Okata, they used to former at Advanced Cell Technology, who was just acquired, and it hasn't been done yet because there seems to be some problems by Acela on some of the things. So again, it's a roller coaster we're caught in many of these cases. But one of the things I tend to look at more specifically to really measure a company is to understand the amounts of the G&A, general administrative costs, as a part of operating expense. That's one little thing I look at. The second is how invested are the CEOs, the CMOs, the CFOs in the company. When I see a good amount of them buying the shares in downdrafts, to me, that is a signal that they are fully committed to doing something and doing it right.
I think as analysts, yes, sir. I was going to say, I think as analysts, we would all very much like to see the regenerative companies succeed. That's, I think, why most of us are here, because we actually care about some of the companies here, or most of them. Unfortunately, history has shown us over the past few years or decade that many haven't. So therefore, unfortunately, you're not getting the benefit of the doubt.
Steve, you mentioned the importance of Plan B. What's your advice with respect to how debt should play into Plan B for, cash out companies, I guess, myself, in the equation?
Man, debt, it really is that four-letter word for the microcap companies. Because if with equity, it's like you can have some bad investors. You screw up on one thing with debt, you don't own the company anymore. Someone becomes debtor in possession. I mean, Dendrion is the perfect example of going out there with a franchise that, in theory, if they'd kept the numbers simple, they'd still be in business today. But it's one of those things where, which actually does lead me to the point I want to end on. How many people here know ATMs? Okay. They're not the things you take cash out of, okay? They're at the market transactions, and these are really problematic now. I mean, for companies that are high flyers, I have no problems with them because for all intents and purposes, let's say your stock goes up by 70 points. Okay, guess what? You're probably entitled to take some of this irrational exuberance and put it into your bank account. But let's say you're a microcap flooding the street with an ATM. You're going out there and you've contracted a bank, and I know you'll find it hard to believe that banks do sometimes these types of things, but they're going to go out there and sell these shares into the open market. Now, as your job as a CEO, as a president, as a chairman, it's to explain what you're doing to potential investors. It's not to have shares dribbed and drab out to replenish your coffers. And I find that to be a significant problem with these microcaps. Again, if it's used properly, there's no problem. And again, with debt, if it's used properly, there's no problem. If you're going out there and building something and there's no liens on you, it's just a facility that you need to build and they own the facility, that's a clever way and a good way to use debt. But if you're going out there and saying, well, we just need to make it to this quarter because that's when we know that that we're going to see positive results and we're going to do not one but two, deals, yeah, right. You've got a better shot with the lottery.
But they are a vehicle. So asset specific, maybe, if you could just tie it to a single asset. Right.
Well, I'd say on top of just ATMs, there's a number of structures out there currently, and I'm not a banker, but I see companies that are swallowed by warrants, options, there's some exploding options, there's floaters, there's a number of vehicles which have really damaged small cap companies.
So, in my answer to your question, or to any public company, I would stay away from debt, wholeheartedly. That should be option Z, not B. Equity at any given time, no problem. Look, you have investors who are willing to invest, who are there to buy shares. You know what? They know the risk. They take it. You need to sugar it up with warrants. That's fine too. Because we've all been in agreement here. Pretty much. I'm gonna maybe stir up a little bit of controversy or end on a little bit of controversy. I actually don't mind ATMs. We don't do ATMs or anything else. I don't mind if a company has an ATM. What I mind is if, and Steve alluded to this, is if they're dribbing out, or tapping this ATM like every day, right? Because now here you are, pounding the message that investors should be buying this, right? And essentially, the company I know has to raise capital, but they're essentially selling against you, right? On the other hand, if you have some good data and the market rewards you on that, right? There are two options, right? One is to go hire a bank and you find the investors and they come in on a structured deal, and the other one is to do an at the market, financing. And personally, I think both options are great. The worst option is not to do anything at all. The worst option is when CEOs, and I've run into management teams who say, well, clearly the market is not valuing me accurately. I should be at least twice this much. And that's when I'm going to raise the capital. And frankly, at that point, you should be fired. Because the one thing that we know about, the equity markets is it's damn well unpredictable. And, what the market is behaving like today is not going to be what it's behaving like tomorrow. And you will kick yourself if you don't take advantage of those moves. I'll stop that.
I've said the same thing. It's basically a vehicle. It is a tool. But at the same time, it's something that has to be controlled. It's not just, it's like going to the ATM. It's still drawing down your account as far as I'm concerned, and you're going to have to replenish it somehow, sometime, somewhen.
I think we're out of time, so we're going to wrap it up here. Steve, Reni, Henry, thank you for your time. Thank you for the questions and your participation.